Hey guys, which should you trade? Forex, indices, or stock market? Now, your success in the Forex market determines on what you are actually trading. What you are actually trading, it lies a lot in it. It lies a lot in it. Someone like me now, I don't really trade gold, but I know a lot of people who trade gold and make money in it. It's not that I cannot trade gold and make money, but I found a place where I'm already making money and I'm enjoying it. And so the point is, your success in Forex, implementation of your strategies determines or depends on the various things to trade. What are you going to trade? Are you going to trade indices? Are you going to trade Forex? Or are you going to trade the stock market? That is what we're going to be looking at in this video. Now I'm going to be giving you differences. I'm going to be giving you facts. Why this one is better than the other one, why you should prefer this one, and at the end you can do your consideration and know which one you prefer, in trading. We're going to start first of all with the volatility of the market. Indices, the less volatile market is the Forex market. The Forex is the least volatile. It's very non-volatile. So if you have small accounts or you're just starting, you don't have enough capital, then the Forex market is the one for you. You need to trade the Forex market because it's the least volatile. You can just take small and it goes small, little by little. Before you know it gets up to 20, gets up to 30, gets up to 40, and that's it. It's not a huge stuff. But coming to the most volatile among these three is the stock market. The stock market is very volatile. It's very volatile. Then the indices market is in between the both. And that's why I so much love indices. And that's why I prefer indices to a lot of other, things. It's in between the both. You can trade indices, indices is volatile. It's not so volatile, but it's not as it's not as volatile as the stock market, but it's way better than the Forex market. That is why it's very nice. It's very nice. Another thing is that the indices market works 247. That's every day, every time, in the morning, in the night, in the evening, during the weekends, and every time. It works always. There's never a time where you can say that it stops. And then another thing there is that the indices market has no effect on news. There's no news effect on it. It can work anytime with no news effect. News effect does not work on it. It's very nice. But one of its disadvantages that a lot of people complain about is because in terms of indices that is well known, that is popular, that I trade, like the Deriv indices that a lot of people know about, the volatility indices, volatility 75, 25, 10 1S, volatility 75, boom and crash, jump indices, range break, all those things are Deriv indices that is very popular, and a lot of people know about it. And whenever we talk about indices, most people always like referring to it for the discussion. That notwithstanding, one of the reasons why people are always very they don't really want to talk about it, or they don't really want to use it. I'm going to tell you this so that you know which one is best for you. I'm giving you the criteria, so this one is good, this one is not good, so that at the end of the time you can make a decision and say, okay, yeah, I've made my analysis well, and so I'm going to take this or that. So the Deriv indices is very it's not really unlike the Forex pairs and the stock market that is controlled by something. We believe that the Deriv indices is controlled by more like somebody or something, or a robot is controlling it. Is not done by real facts, and so it can be easily manipulated in terms of something like that. So another thing we're going to talk about, another criteria I'm going to use as well, is leveraging. Leveraging in Forex market, leveraging and margin. Of course, you know that it's very important. Sometimes when you have this, when you have a trading that is negative, and then all of a sudden the account blows, or the account finishes, or something like that. Maybe you still have $8 there, or you still have $5. Margin call. It's all because of the margin you use. It's all because of some of those things are interrelated. So that means that once a leverage is going up, the margin is coming down, and once a margin is going up, the leveraging is coming down. For the leverage of volatility 75, God, of indices, I know that the volatility indices, the leveraging is around 1:200. That's the highest I think they have. Stock market is 1:20, and I think the Forex market is 1:1000. And the effect of leveraging on the Forex. The higher the leverage that your broker provides, the less money you need to actually fund an account to actually take a trade. And then the more the leveraging that your provider provides, the less this thing. Okay, sorry, yeah, it's interrelated. I said it twice. The less leveraging leads to, oh God. The less leveraging leads to a higher amount of money, to be traded the account with. And a high leverage means that you can be allowed to use a small amount of money to trade the Forex market. So these are some things that you can check and you can do. I have done my analysis and I prefer indices trading. I have a lot of friends who trade currency pairs. I have a lot of friends who trade stock market. I have a lot of friends who trade a lot of things and they're making money in it. The fun of the whole stuff is there's money in it. Just choose the one that works best for you and use it. Thank you for watching this video. The name is Milk Deriv and all we do is Milk Deriv. Thank you very much. Peace.